So we're defensive equities right now, and we do think that, notwithstanding some of the green shoots that we did see in the first quarter, we think that the market was overextended going into the beginning of the second quarter. That said, when you talk about companies like Apple, we do think that you want to be owning sectors or companies with good balance sheets that are a little bit more defensive, that have good earnings growth and visibility. And I would say that the tech sector, yes, it got hit hard, but it is a sector actually that we think can do well, particularly in the software and services side because of the sort of regular annuity stream of these services. So we like companies like Apple with good balance sheets, and we think that at these levels, once some of this trade tension eases, this is a sector that you're probably going to want to be in. We would actually underweight sectors that are much more cyclical, like the semiconductors, which we think are going to be a weaker position going into the end of the year.
Let me ask you this. What if these tensions, as you call them, little squabble, as the president says, what if it lasts for longer than investors think?
So it likely is. So it likely is going to last.
It already maybe has.
Right. It already has, and it's likely going to extend at least into June when President Trump and Xi sit down. So you still have another 3 to 4 weeks of lack of visibility with respect to the trade tensions. That's going to keep, I think, markets under pressure and going to keep equity volatility higher. So yes, we're getting a little bit of a bounce today, and maybe can extend for another couple of days. But this is not a time I think you should be piling back into the markets at this point, because I think there's still going to be a lot of uncertainty in the market over the next couple of weeks.
I want to be clear, though. Your portfolio manager at Pimco, are you short the S&P right now?
So yeah, so we have a short in the S&P.
Okay, so I mean,
or an underweight in the S&P relative.
That says broadly where you think the stock market is going in the near term, at minimum.
Right.
How quickly would you turn that around?
I mean, we could turn it around very quickly if we see either valuations and levels get to a level where we think it's attractive to start buying, or we start to see more positive developments either on the trade front or on economic data.
So if you're underweight that, what are you overweight?
So we're overweight. I mean, right now in our treasury, we're overweight treasuries, we're overweight mortgages, we're overweight more defensive assets in the portfolio overall. And then we're also overweight quality in our equity book. So companies with good balance sheets, with good earnings visibility that are able to deliver free cash flow generation.